Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out what big companies are really up to and not what they say they are up to. Today we're diving into the preliminary proxy statement for Builders FirstSource, a major player in the building materials game. It's like peeking behind the curtain before the shareholders' big vote. Hopefully there will be more drama than in the houses built from their supplies. This isn't just about some boring annual meeting though. This document actually signals some major changes coming to the company, including board shakeups and a big move to get rid of their classified board structure. Plus, we'll take a look at how the top dogs are getting paid. Let's get to it. First up is a message from the top. Both the chairman and the CEO are saying things are looking bright, talking about resilience and shareholder returns. They highlight some wins like productivity savings and acquisitions, while admitting there was some complex operating environment due to interest rates. This letter is basically a marketing pitch to convince shareholders everything is great. We will see in the tables if it is so. The company made a big move by buying back a lot of its own shares, around $1.5 billion worth in 2024, and since August of 2021 they repurchased more than 46% of their outstanding shares. That's a big deal because it means the company thinks its stock is undervalued and that they believe on the long-term value. It reduces the number of shares available, which can boost earnings per share. There have been some changes at the top. Peter Jackson took over as CEO and Pete Beckman became CFO. Two new board members with expertise in e-commerce and tech were also added. They are also proposing to get rid of the classified board, meaning directors will be elected annually, not in staggered terms. This makes them more accountable. Okay, some basic housekeeping about how to vote. You can vote online, by phone, or by mail if you get a paper card. The important thing is to make your voice heard. If you own your shares through a brokerage, get a legal proxy if you actually want to vote in person at the annual meeting. Here's a quick rundown of what shareholders will be voting on: electing directors, an advisory vote on executive pay, ratifying the company's accounting firm, and those big changes to the company's structure we talked about. For each item, the board is recommending that you vote for it. Time for the nitty-gritty about the board itself. 3 Class 2 directors are up for election, to terms expiring in 2028. Mark Alexander, Dirksen Charles, and Peter Jackson, who is also the CEO. There's some background on each nominee, highlighting their experience and qualifications, including committee memberships. Mark Alexander brings financial and executive experience and is on other public boards. Dirksen Charles has corporate executive and accounting experience. And Peter Jackson is the CEO with decades of leadership in this industry. There is also more information on the rest of the board. Paul Levy is the chairman and has lots of investment experience. Cheryl Lee Ninois and Maria Renz bring technology expertise, and Dave Rush, the former CEO, is also staying on as a director. How much do these folks get paid? Well, the table lays out the director compensation. And for most of the independent directors, they get about to $144,000 in cash, plus about $175,000 in stocks, for a total of approximately $300,000 each. As a chair of the board, Paul Levy makes $269,000 in fees, and adding stock goes up to $444,000. This is pretty common for companies of that size. This is a look at how the board is structured. They need to have committees define their purpose and who sits on it. Borky, audit, compensation, nominating and corporate governance committees. Newly formed technology committee will help them oversee digital strategies, an area where the home building industry is lagging other industries. Most of the board is made up of independent directors, meaning they aren't executives and don't have conflicting interests. This is a good thing for corporate governance because it helps ensure the board is acting in the best interests of the shareholders. The audit committee basically makes sure the numbers are solid and the company is following the rules. They oversee the financial reporting process, compliance, and the performance of the company's auditors. They also keep an eye on cybersecurity risks, which is super important these days. Builders FirstSource is serious about ethics. They have a code of business conduct and ethics that applies to everyone, from directors to employees. They also have a hotline for people to report concerns anonymously. It has been observed that the companies with the strictest internal codes also have the highest profile fraud cases. So let's hope that is not the case here. Now they're talking about corporate social responsibility, which includes reducing their environmental impact and supporting communities. They say they avoided a certain amount of emissions, recycled waste, and gave millions to charity. It is also great PR. Some of the top executives and their backgrounds are detailed. Pete Beckman became the CFO, Steve Herron is the Chief Operating Officer, and so on. Good to know who's steering the ship. Alright, let's talk about how the executives get paid. It's all about attracting, retaining, and motivating the right people. They are aiming for that sweet spot where executives are paid fairly, but also incentivized to perform well and boost shareholder value. We will see. The company had goals for adjusted EBITDA, working capital, and return on invested capital. They hit the working capital target, but missed the goals for EBITDA and return on invested capital. There is base salary, a bonus plan, and stock awards. The bonus is tied to company performance, and the stock awards are designed to align the executives' interests with the shareholders. They compared themselves to other companies in similar industries to make sure they are paying their executives a competitive rate. Their peer group is a list of about 20 other companies to measure themselves against. Some of these are Fortune brands, Lennar, and Wesco International. A quick look at the base salaries. We see Peter Jackson made $752,672 and 672. Bachman got $405,405. Steve Herron received $5,405. Steve Herring received $2 and Tovey $4. And Scott Robbins is listed at $509. These are base salaries. The executives can earn more than just a salary. They are bonus depending on performance metrics. The metrics were mostly financial with some CSR targets for safe work environment, etc. And for those corporate people, it is 70% based on adjusted EBITDA, 15% on working capital as percentage of sales, 5% REA, and then a few 5% based on employee training. On the adjusted EBITDA had a payout of about 29%. The working capital got them another 19%, and trainings were fully hit, and the RA, which the company met, had a payout of 5% of sales, 5% RA, and then a few 5% based on employee training. As a result, in that table listing actual percentages earned out of target from page 43, and on the actual bonus for Peter Jackson for 2024 was $97,000. Steve Herron got a little over $63,000, and Scott Robbins from the West Division took home $470,000. There are a few interesting things to observe. Mr. Rush, who retired, got full bonus at nearly 1.1 M. Last sign-on bonus for Johnny Cope, the new commercial operations officer, at $93,000. The table on page 53 summarized the various compensation components such as the stock awards and other compensations and their total. The company can claw back compensation from executives if they mess up and have to restate financial results. A bit of insurance to keep folks honest. Here is a big one. Currently they have a classified board, but they are proposing to get rid of that structure and have directors elected every year. This makes the board more accountable to shareholders. This change will be phased in over 3 years. A yes vote from 2/3 of the shareholders is needed to make this happen. Right now the board can only have between 3 and 13 directors. They want to remove that limit, giving them more flexibility to add qualified people to the board as needed. A 2/3 vote is needed for this one too. Delaware law recently changed to allow companies to protect officers from personal liability in some situations. So Builders FirstSource wants to amend its charter to offer that protection to its top executives. There are limits though. It doesn't cover breaches of loyalty, bad faith actions, or illegal behavior. And the endnotes are just legal information for you. So what's the story here? Builders FirstSource is trying to navigate a tricky housing market while keeping shareholders happy. They're touting their investments in technology and value-added services, share buybacks, and focusing on efficiency. The new CEO and the board changes seem to indicate a willingness to shake things up, and eliminating the classified board shows they're listening to shareholders who want more accountability. Looking at the financials, they missed their targets for EBITDA and return on invested capital, which could be a concern. This could be a red flag or just a blip caused by those complex operating environment they mentioned earlier. We need to see how they perform in the coming quarters. Overall, Builders FirstSource seems to be trying to adapt to a changing market. They need to execute their strategy effectively, continue to generate cash, and show shareholders they can deliver those promised returns. It is definitely a wait and see situation. Thanks for watching. If you found this helpful, give it a like and don't forget to subscribe for more corporate decoder deep dives. What do you think about Builders FirstSource's plans? Let me know in the comments below.